Good morning. I thought today we'd cover off on just a reporting season wrap last 6 weeks ago, and then we'll talk about some research we've been doing, and it's that a lot of our positions are based on, and as Anton said, the market's very short term. We're looking past that for the bigger shifts and trying to understand those and how we can position the portfolio. Right. So the chart up there, you can see, I'll just describe it. It's the highest P stocks in the market, the 80th percentile, divided by the 20th percentile, so the lowest multiple stocks in the market. As it's positively sloping, what that's saying to you is, and everyone's witnessed this, very high multiple stocks have re-rated a lot. Okay, the wise techs are up 40 or 50% in a couple of days. CSL's put on another 15, 20% quite easily, etc. So the market's paying up for quality. So at a point now, you're always told to pay up for quality. At Perpetual, we look at quality and value. So you've got to think about what you're paying for it. You make your money in the buying. If you buy a great company at a great price, you don't really worry after that. If you bought CBA at $5, you don't really worry about it at 80. So what the market's doing right now is they're looking for any quality stock and bidding up the value of it. Now those market multiples have moved up 15 to 20%. So if you look at some stats for the reporting season, so the top 15 stocks in reporting season are up about an average 17 to 18%, but the market's EPS upgrade's been about 1.5%. So there's been material PE expansion. If you look at the sectors that had the upgrades, everyone would have thought it's the tech sectors, etc. No, it's not. It's steel sector and telco sectors. They're the only two sectors that had net upgrades in the period. Now, telcos have been beaten to death for the last 3 years, so it was a matter of time before the market's expectations got so low, too low. But it was the steel sector, mostly because of the cyclical winds behind it. Now, that everyone's buying these other stocks, there weren't actually a lot of upgrades, okay? Minute. But people were willing to value that dollar of earnings 15% more than the day before, even though there was not much change in the prospects of the company. So we talk about quality and value. The value part is the part you've got to be really worried about today. When you look at the cash conversion in the market today, so when you look at working capital being converted into cash, it's moved from 21 days to 29 days in this reporting season. So that's basically saying that companies are finding it hard to convert their sales into cash or their working capital into cash. Now that's quite concerning because every year a company sends you a love letter called the annual report. Okay? There's nice glossy marketing bits at the front and the really complicated stuff's at the back where they don't want you to really read. So that's where the accounts are, okay? And they'll tell you what the profit and loss of the company was that year. Now the profit and loss is based on accrual accounting. It's what they want you to think they make that year, okay? The interesting one is the cash flow statement. So what you do is ignore the P&L. It's interesting. That's what the company wants you to think. Go to the cash flow statement, 3 or 4 pages past the profit and loss, and you can work it out for yourself quite quickly how much cash the business is actually generating. So in the management presentation, there'll be this thing called EBITDA. We all know what that is, earnings before interest, tax, depreciation, and amortization. Pull that number out. Go into your cash flow statement and just get the top 2 lines of the cash flow and the operating cash flow, receipts from customers, payments to suppliers. Okay? Work that out. If those 2 numbers are very different, EBITDA and the cash number, if the EBITDA is above, start to worry. Because what they're saying is, we are not actually generating that much, that profit is not cash. The real cash number is very different. And then what we've witnessed over this reporting season is that the cash conversion has actually started to decline. And remember where we are in the cycle today. We're at peak margins. Operating margins are at peak. We've had very low inflation, an extended economic cycle. Companies have been basically buying back stock with low cost of debt. They haven't really been investing because inflation's low and interest rates are low. So it's allowed them to get away with sort of sweating the assets today. If you look at what happened during reporting season, costs were double what was expected, cost growth. All right? Market's gone for about 2.3% cost growth, came in at about 4.5%. So there's now all of a sudden inflation. So if you think about it, commodity prices are all up at least 100% in the last 3 years. The energy price is up at least 100% in the last 18 months. So they're the factors of production, and the labour markets are reasonably tight. Now everyone talks about you can't see wage costs going up. Well, we could tell from a lot of the mining companies talking about tight labour markets in mining. That's usually the first wave you see. So what we're seeing is the tailwinds turning into headwinds for companies. at the moment. So that's why it's really important with this chart that when you think about the really exciting stuff that's done really well over the last couple of months, or last 12 months actually, that there's the market's become quite bifurcated, it's split into two. There's a lot of, as Anton would describe it, solid companies with people have complete lack of interest in. They're on 14, 15 times, some on 12 times, pay a 4% yield, 4.5%, fully franked, and they maybe grow 5 or 6%, maybe 3%, quite boring. Now those companies, fair enough, sometimes you don't need to own them, but when you've got a market where people are willing to, they have perfect foresight. When you're paying 40 times for something, you have perfect foresight. That's the assumption. It must be, because that company has to grow up 40% to get your money back, right? And no company in history has grown at 40% for more than 10 years. It's virtually impossible. Profit, not the top line. Everyone can grow top line. Profit. So when you think about behaviour in reporting season, behaviour is really important because it's instructive as to how companies are dealing with changing economic fortunes. So when you think about, I've been told when a CEO buys stock, it's equivocal. When they sell it, it's unequivocal. Right? You start to see insider selling start to lift. Okay? They know more than us typically as an insider. And I'm assuming they've all got tax problems, which is the most, or they're getting divorced. It's the two reasons most cited for CEOs, is they need to pay someone or pay the government some money. But that's instructive as well. It's a lot of little 1% you've got to look out for as to what's the condition of the market, is there value on offer. The other one you've got to think about is, it was quite remarkable actually in this reporting season, the number of restructurings which have been announced, whether they're asset acquisitions, offshore acquisitions, out of step with the core of the business, divestiture, selling assets all of a sudden, and reorganisations, where companies use some great accounting tools regarding, if anyone knows, if you make an acquisition, you can use this thing called acquisition accounting, where you don't have to, you can state the asset, the accounts of that company that you acquired on day one. 12 months later, you can change those accounts. So what typically happens, this is a little trick, is they will write off the entire inventory base of that company. All the working capital will be written off, miraculously. That will be added to the purchase price to make the acquisition price equal. And then miraculously, a year later, they'll sell all that inventory at market value and realise this huge profit. Okay? You can do that once. And then the truth arrives that you have to actually operate the assets. The other trick that a lot of companies are using is that they are reorganising. So shutting down a plant over here, building it into another country which has low cost, okay? And saying that's a non-recurring item. That's called capital expenditure. That goes well above the line, and that's part of business. So CEOs are trying to say to you, don't look at our reported profit, which the tax man's interested in. Look at our underlying earnings, which is a management number. So have a look at all these look for these sort of tells, these little signs that companies are starting to struggle, but always focus on cash. If that cash flow number is below EBITDA for a persistent amount of time, start to get worried about your holding because something's going on in the business. I'm pressed for time here. I'll move on to, we've got a large position, overweight position, significant position in energy in our portfolio in the PIC. So we own Woodside Oil Search, New Hope Coal, which is the new tobacco, and Incitec Pivot, okay? The reasons are these charts. So the chart on the left there, it shows oil and gas reserves for the integrated oil companies, okay? And obviously in about 2006 to 2010, the oil price hit about $150 a barrel. Everyone remembers those days? And what's the solution for a high oil price? A high oil price. It was worthwhile all the integrated oil companies to start exploring and taking risk and looking for new discoveries, which they did. Oil and gas reserves went up a lot. But in the meantime, from 2012 onwards, you had the shale gas revolution, shale gas and oil revolution, where they discovered new ways of extracting reserves out, and that produced significant amounts of new oil, untapped oil. And you've had the oil price, bottom in 2015, 2016 to about $33.80 a barrel. So what's the solution for a low oil price? A low oil price. So you can see on the right side there, that's the exploration budgets for most integrated oil companies. They've slashed them. Now, the scary numbers are, that includes all the new shale gas discoveries. So if you take that out, shale gas represents 75% of reserve growth in the last 5 years. So you take that out to normal, traditional, conventional oil, find a big field, drill a hole, take it out, rather than putting lots of holes in the ground, Swiss cheese style. Integrated oil companies' reserves position is very weak. So we quite like the fact that we're looking for long wave cycle capital movements. So how easy is it for capital to go in and out of an industry? When it's a very long wave, and this is definitely a long wave, and exploration could take you 5 to 7 years to find something, then you've got to commercialise the field, etc. There's another 5 odd years. You're at 10 years before you get some oil out of the ground. So what you have here is a market which is very short. Okay. Now, when I think about the positions we're in, we're very long gas, and particularly with Oil Search. It's reasonably well held. Most people own it. The reason we like Oil Search is, it's remarkable to say this, it's got lower political risk than being in Australia. All right? It's just one real problem up there, and I'm assuming you can always have a conversation at a cafe to sort out any sort of reservation agreement in Papua New Guinea. So it's a bit easier to deal with up there. And the economy needs, that's the biggest industry in Papua New Guinea. So it's definitely needed. The reason we're we're looking again for those little 1%ers, those little signals about what's going on in the oil market. If everyone's here, watch the carbon price in Europe. Okay? Pay attention. Because it's about $24 a tonne at the moment. Okay? A lot of the economic, so Paris Accord, you look at a lot of the new environmental policies which are being implemented today, you can work backwards to the amount of carbon required, the carbon credits required, there's not enough. So we're looking at a $40 to $80 carbon price. Now at $40 to $80, a lot of the energy companies, the electricity companies that are burning coal, become very uneconomic. So what will they do? They'll switch to gas. Okay, so you'll get a lot of gas peaking power, gas peaking stations being built to basically add the cheaper form of energy. So this perception there's an LNG glut, okay, in the world, there's too much LNG, it's a furphy. Because China just signed a 20-year agreement with Qatar for about 3.8 million tonnes of gas. Now everyone was hoping it's about an 8 million tonne expansion for Qatar. All the countries which are short energy were looking to get a piece of that gas. Well, the Chinese just signed a 20-year agreement for basically almost half of it. So the world is actually quite short energy, we think, even with an economic cycle. So we still think there's another good couple of years. Now, it depends on what the equity value, what happens to the equity value, can get overpriced. And that's when we typically will actively manage the position. But we are very long energy. We're very short bulk miners at the moment. Not short, but we don't own any, basically. So have a think about your energy position. This is an interesting chart I brought up. I was in Europe for about, with another portfolio manager from Perpetual about 6 weeks ago, because open banking's starting here on July 1. A lot of people aren't talking about it. Everyone's obsessed with the Royal Commission. The Royal Commission's in, it's done. Okay? The banks have been beaten to death. There's not much else that can happen, but actually open banking's going to happen. So in Europe, UK, it's already occurred. In Europe, it's more around data laws, where what's basically happening, I can describe, this is the best description I can give you, is if everyone remembers, I'm assuming a lot of people in this room will, so in the 90s, when you had a mobile phone, you had to shift to another operator, you lost your mobile number. They owned the mobile number. So you had to go, so the switching cost was enormous. You wouldn't want to do it. Okay? The way you should think about open banking is your credit data or your transactional data now belongs to you, and you can offer it to any other institution. They can get a full view of your credit history, your payment history, your savings history. Okay? So when a bank's sitting there thinking about whether I should try and chase you as a customer, the biggest risk is I don't know if you're a good credit. Because in Australia, we have this thing called a credit bureau. It's a negative reporting system. So whenever you miss a payment, it gets recorded on the bureau. So they always see the bad credits there. They don't know who the really good credits are. They suspect they know, but they don't know where you are. Under open banking, your switching costs, and I mentioned this in Melbourne, if everyone's tried to switch a bank account before to another, you lose the will to live, right? It is so complicated, and they make it so convoluted, payment figures and times, and it's your financial assets, it's your wealth, right? You're desperately worried about something going wrong. Under this rule, that'll be handled by the banks between them. You won't even have to be involved. So it makes a huge difference to switching costs for banking, okay? Now, how's this going to play out over the next... We think it'll be a slow start, because I think people are quite conservative the way they deal with their banks. They still have trust with their financial assets, their credit and deposit assets. But over time, we think that this will be, if you look at the UK, you look at mortgage margins in the UK, they are half of where they are in Australia because of competition. There was a Productivity Commission report last year where it basically states why there's so many duopolies and oligopolies in Australia. And it is because of switching costs. It's very difficult to switch to another operator. So open banking is starting in July next year. It's a pretty hard target. And it affects the 4 big banks. There's an opportunity here where you'll actually have to see banks change their nature. Okay, this sounds quite strange, but banks have to become customer-centric. Because your ability to leave has just disappeared. You can move quite easily. So I guarantee all the good credits in this room, I suspect you get a phone call in about January, February this year from your current bank saying, you know what, you've been such a great customer, I'm going to cut your credit card rate by half. Okay? And if you really want to think out way past, one of the executives we saw from a bank overseas said, we expect that we'll have just one account per person, which will be your home loan account wrapped up in your credit card, wrapped up in a home loan, into a car loan, etc., and you can use it as you will. And it'll be reasonably well, cheaply financed. So that's sort of the change that's coming. We're sort of positioning ourselves for that. And I've run over time. Peter's going to yell at me. Okay, so I'm going to keep going. No, I'm done. Hopefully there's enough in that for you to understand that, a bit like what Anton said, look past the gaze of the market here. Look at there's some money to be made here. There are parts of the market today which actually represent reasonable value. I'd be hunting around there at the moment. Thank you.
Before you go, there is a listed, a LIC that people can invest in to get all your ideas.
Yep.
What's that?
Oh, Perpetual Equity Investment Company.
Yeah,
the PIC.
PIC. He's great at telling stuff, but he's not a great advertiser, is he? I really like you for that.
I don't like the hard sell.
Yeah, but you might have scared him about one thing. I know you've got to go. You can't say the panel, so I'm going to pest you on one question.
Yep.
You had up the Westpac,
yes.
WBC. You don't think open banking is going to be a threat to the big four, do you?
I think the market will think it's a bigger threat than what it will be. The market will discount. I think there's a chance it may discount the equity. I think the majors are actually working very hard to digitise their cost base. So there is a lot of double handling within a bank, processing of applications, etc. There's a lot of people, unfortunately there's a lot of people in that, and that's going to be moved out of the bank really aggressively. I suspect post-Royal Commission, you might see some reasonable announcements regarding cost outs for the banks.
And do you, if banks do cop a bit of a clobbering post-Royal Commission and ahead of open banking, would you think there's a buying opportunity?
I think there is, but just one footnote. Yeah. If we have a housing crisis, whatever I just said means nothing.
We won't have a housing crisis.
Yeah, don't worry.
Okay.
So credit costs are the biggest thing that kills a bank.
All you have to do to avoid a housing crisis is stop reading Fairfax newspapers.
Fair point. All right,
okay.
Thank you.